it when I told them what we're doing tonight, and they're like, "Oh, is it going to be recorded?" I said, "I'm pretty sure."
Yeah.
Being we're trying to drive membership that it will be available.
Yeah. So it is recording right now.
A couple
Yes,
of parents want
if
to learn.
if you'd like to come in and join so you can watch the
You guys are
recordings if you
great.
missed it.
Yes. Yeah. This is going to be a good one. Even though we did go over a topic like this a few weeks ago, maybe a month or so ago, it's always good because I don't apply this method, and I'm going to give the show over to you guys. You guys are probably going to teach me a lot tonight. Hopefully, I'm going to have more of an understanding. More of a I think it's just confidence. I don't think there's much understanding. I mean, you guys explain it pretty good when you talk about trading option spreads for income, etc. Using that for protection. I'm straight up missionary position with the options.
You know what? But and there's nothing really wrong with that. And so you got to. Someone was talking about a strategy they were talking about. It's like you got to work for what works for you.
Yeah.
We're just here to share some information. You guys can look at it, change, play with it. But there's nothing wrong with just buying calls and buying puts. But
yeah, but you know what? When it comes to percentages, I live and die by statistics. I love them. I love percentage. I love just having odds. I love everything about it. And Rob, he mentions this all the time. How well, the decay works in your favor if you're a seller, right? Or I don't want to mess up, but it's obvious. But yet I kind of not pay attention to that trade for some reason. Maybe I'm just more. I think of it as just personally, I haven't wrapped my hands around it. So I'm just going to let you guys run with it tonight. I'm going to ask you my questions, and hopefully we got open mics tonight. So if you have any questions out there, you could reach us on Skype, and the Skype number is at DayTraderRockStar. That's DayTraderRockStar. And then you probably have to become a friend me, and I'll okay you, and then you could just call in if you're not a friend already. And if you can't find me, then it's probably John Kurisco, Kurisko. Markets are actually pulling back right now. Yeah, no, I know. So I'm loving the having that decay work for me. It almost seems like something I would want to do. I like to automate things, and when you say that you could get into a trade, as long as it stays above a certain number, you're generating or you're gonna profit on this. That's though the bad thing is I feel that we're going to learn about this tonight is how much capital does that take? How much does it hold over time? If you're talking probably holding a position longer than I would hold a position and trading it. All right, so I'm going to just say welcome everyone. Keldar is on the line with us. Tight Stops is on the line with us, and we're going to talk options tonight. So that was my beginning thoughts. You guys could jump in anytime you want.
Does anyone have questions about some of the terms he did, selling premium or any of that? Are we good on that?
Oh, yeah, I have questions. I would like to start from the basics. I think there's a lot of people out there have a lot of a lot of questions on that.
All right. Well,
I know that takes up time too, but if you don't do it, you're not familiar with it.
Can I simplify this a little?
Yeah.
If you're buying a call, you're bullish. If you're selling a call, you're bearish. If you're buying a put, you're bearish.
All right.
If you're selling a put, you're bullish.
All right. So why would you sell a put and why would you sell a call?
Well, I'm going to go. Yeah. When you buy a call or sell a put, you have only one. You have two options that can happen.
I wish I had an image of this.
You can win money or you can lose money.
Yeah.
Correct.
And price basically, for you to win money, it has to go in one direction. The advantage to selling puts or selling calls is that you have two ways to win. All you need to do is have a price to either hold it where it is and it can wobble there or kind of move a little bit away from where your strike price is. It can go a little towards it, but you don't need it to really move much to make money with it. That's the advantage. You get another way to win. So you automatically your percentages of being able to be profitable increase. So instead of 50-50, you're, what is it, 67.5 or 66-33 or something like that. So that's an advantage.
I am looking at some images on this site here. I don't know if it would be better to show an image. I don't know if either of you two have something that you could share with us on talking about, when we see a picture like that, you could kind of understand it better, like time decay versus price levels and stuff like that.
I'm getting ready to get to that, Tetris. I have some pictures for the room if anybody is interested. If you are a trader, I have to admit, I don't particularly care for Toss as much as a trading platform. I keep a whopping $12.30 in that account just so I can access the toys. But it has some incredible things on options math and every indicator you could ever want. I am posting what's called an options chain, into the room.
Okay. And I'm going to put that on the screen so you'll be able to see that too. Thank you, Keldar.
This is from Thinkorswim. This is if you pull up, these are options on the S&P 500 E-mini futures.
All right, just give me a second. I'll bring that up on this side here.
While you're doing that, we were talking a little, you mentioned something about how much to trade options, you need a margin account. To have a margin account, you need $2,000. So that's the starting point.
Is that for all brokers across? Is that like FINRA's?
That's the standard minimum.
Standard. All right. So for a margin account, you need 2,000.
Okay. So I'm putting this up. So if you look on, this is a standard options, and you can customize the charts. You guys can right click and download this and zoom in if you can't see it that well on his screen. But you can change the columns you look at. But the important one is, for me, is you've got one called implied volatility.
Mm-hmm.
Vinny, there's a minimum to sell premium or sell calls because you're using margin to do so. So yes, Robinhood has a minimum for that. Anyway, there's implied volatility, which Rob can get into a little more of those strategies if he wants. The one I'm more interested in, the one I like, is probability of in the money. These are options that expire this Friday in the E-mini options. So if you look at 31.15, if you look at that strike price, that's that column in the middle, and you look at the calls are on the left, the puts are on the right. Now, the underlying for this is 50 contracts versus a regular 100. So when you see 105, that's actually $65. But you could make $65 by selling that, and there's a 90% chance you'll keep your money. That's how I use Toss. If you look, there's a 22 delta with the market being kind of directional up. I'd like to be a little further out, but something like that. I actually have the 31.10s for Friday.
What is the delta telling you?
The delta is the amount of the amount the price should change for a $1 move in the underlying option.
Beautiful. So it's supposed to move 10 cents for every dollar it moves.
Basically, and I'm looking for something that's going to be about an 80% chance that I'm going to be right, mathematically.
So you're jumping over here to probability of being in the money, and you're buying these. And that's I want. All right, go ahead.
Similar.
Yeah.
So for everybody, and I have to admit, last week, after rolling it twice, I had the 30.50s, and I sold those when the S&P was at 30.15, and I'm still shocked that I had to roll that twice. But ultimately, at some point, I just I've had enough. I'll play and give up. But I took a loss on that.
All right.
But for But for most of this year, I have been using a strategy to, if the market moves 0.5% to 1% in one direction, so 15 to 20 handles or more, I will look to sell calls or puts, whatever the opposite direction of that move is, usually 5 to 6 days out. And I'm selling enough of those that generally I can grow my account anywhere from 0.5 to 1% per week doing that.
That's interesting.
So let's back up to, let's say we started with, let's say we have more money than $2,000, but you couldn't sell this call for $2,000.
Let's start with a round number like 10,000.
10,000. So if you're making, let's say 0.5% a week,
yeah,
well, you're making $500 a week. I was up 40% this year.
Yeah, that's great.
And I took some losses, but almost all the trades I entered had a better than 80% chance of me keeping the money. And to keep the money, and these options for the futures trade Monday, Wednesday, and Friday.
Yeah.
They're 24/7. They have the same tax reporting liabilities as the futures do. So it's still that 60-40 long-term, short-term split. You don't have any wash rule issues.
So these are indexed. So could we back this up a second? Because I might have, I don't know if you went over and discussed what this is. This is the index option. This is not like
the E-mini.
So this is not like the SPY.
No.
No. So you're going to the index.
Mm-hmm.
Why would you do this versus the SPY? I mean, what's the difference? I've never traded the index options.
The tax advantage.
And what's that?
Well, at the end of the year, when I file my taxes, I take everything as 60-40 long-term, short-term gains. Whereas when you trade regular options, you've got to go, how many were wash sales, and do all the funky math for that.
Well, I didn't know that. That's I think that's pretty important information, right?
So, going back to, let's say you can do this with spreads with a fairly small account, but let's say you got $10,000. Well, if you'd start the first of the year, like I said, I'm up 40,000, so that would have been $14,000. You would have beat pretty much every hedge fund manager on Wall Street. Now, they don't work all the time. I got to admit, I've had a couple times when I remember I had some 29-30 puts here a few months ago, and we had some Sunday discussions about trade that were not positive, and I had to roll those out for several weeks, but ultimately that worked out.
So we look at that. So let me buzz in here for a second. I'm trying to take all this in. So you're saying that in the money ES, is this looking out till when? November 19th. So this is
no. If you look at this, see where it says November 19th. To the right, there's the number of days until this expires.
a week.
To the right of that, this is week 3. So it's the third week of the month. There were options that above that. I shot this earlier today, but there were options
2 days.
All
right, so that's on November. 2 days until they expire. So they expire on Friday. So ones that have 2 days expiration, but what on the 101? So you're talking about a call on this would be five-ish in the money, right at the money.
It's 50% of the size of a regular stop option, so you'd be at about $275 to buy it.
Okay, so that's another good.
Now, if I were just flat buying or sell options and futures, I might want to give myself a little more time. I'm selling these. What I'm looking for on a very short-term basis are high probability chances that the market has mispriced itself for the next 5 days.
Yeah.
So I'm looking. Can I scoop up just a little bit? Can I scoop up just a little bit? Can I scoop up just a little bit and do that consistently every week?
All right. So let me ask you a question here. And again, I would love to hear other people's questions. If you'd like to get on, you can call in or just type it in the chat room here at Day Trading Radio. So you say you love to, take advantage of this when the market goes out of a range, like an aggressive move out of a normal move. So a spike down or a spike up, you take the opposite trade and trade that. So could you take that and say, all right, today we had a little breakdown when the China deal came out and it said, oh, maybe the China deal is a little funky, and the market dropped about 4 points. How would you approach that trade? I'm trying to
Well,
find it on the screen here. Would you do that, or you're doing more daily and holding this? How long is your average? Like right here. On the main.
The way I make money with this is
On the main
I am betting. Okay, so on the main screen you've got that little. There we go.
There we go.
Okay, so that other picture I had, the way I can win with this is as long as by 4 p.m. on the day it expires, it's 1 penny below that number. I keep all the money.
All right.
Okay, so in a situation like actually last night, I was trying to sell puts against these options to use up the same margin twice.
Now, when you say last night, did these options trade around the clock?
Yeah, 24 hours.
Because of the new rule?
You've got the same lag time that you've got where the futures stop at 5 to 6.
Yeah. So you can, all right. So how would, all right. So go, all right.
So for example, last night, I've had this Friday option for a couple of days. I am looking to, and that is tying up some margin with interactive brokers. To lay it out naked is about 10 grand a contract. So if I sell a put against an existing option, existing call I already have that it's short, I basically use the same margin. So I actually was looking at the 30/40s today and I had a price and I was looking to sell those as a spread. And we never got to it on that sell-off down. And that actually, I posted a note in the futures room that I didn't think that the options weren't freaking out on that sell-off. In other words, the prices weren't going drastically higher, which led me to think the market was going to go up higher.
That's good.
There's a lot of stuff you can learn just by watching these things.
Oh, absolutely. I mean, especially when it comes to relative strength and weakness.
With your sell-off, if you see the market take a quick 10-point hit, look for some puts, a week out, 5 days out. Whatever you think you can make, $1 on, $2 on, that's got an 80% probability of being right.
Well, I mean, you know what?
That's how I've been approaching this.
Yeah. Yeah, well,
give
me an example of this situation right here. Market's at the highs here. I have a list of topics I wanted to get answered tonight. And again, Rob, thank you for letting Keldar, discuss this. This 30, it dropped. All right.
It went dead on my end.
Oh, you're dead? Oh God, help us all. Am I still in the air? You are, Keldar.
Testing.
I hear you. You don't hear me? Oh my God. This can't be going. This can't be happening. I hear you.
Okay.
All right.
Sorry. I just so I'm going to put a couple more things in the room. This is
Can you hear me, Keldar?
An options chain.
You can't hear me, I don't think.
This is the interactive broker's view.
Hey, Keldar, can you hear me? I don't think you can hear me. I'm going to start calling them names.
This is
Hey, Pumpkinhead.
Basic
4 eyes.
Options chain, but with interactive brokers. That's my primary broker. I also have an accountant, Ninja Trader, and a few others. Merrill Lynch, blah, blah, blah. But we're not into that. So if you had sold the 3110 today, and I can't remember what time I printed this, but you could have sold that for $170.
All right, we're going to bring that
up. You would have.
They're laughing at you, Keldar, in the room. I don't know what. Pixie's just laughing at you. She's always causing trouble.
Why are you dead?
She's just trying to rile things up. Don't pay attention to her. She's always coming in here trying to get all the spotlight. So Keldar can't hear me, apparently.
I can't hear Johnny, so.
You can't. You can't. He's at my disposal. All right, hold on. Someone tell Keldar.
MWS, no. It does not show probability of in the money.
All right, I'm still here. I'm trying to put that. Tell him to continue, and I will put his link in the room, and I'll post what we're looking at now. He gave me another link here to look at, and we're going to look at that right now. There it is.
Order
Oh, he
submitted.
hung up.
1 minute by divergence.
Order filled. Order submitted. Order submitted. Order submitted.
Can you hear me now?
I hear you. I hear you good, Kelda.
Okay.
There you go.
Okay, there we go. Now we're all here.
I'm sorry about it. I don't know what it was, but I got your thing up on the screen.
Okay.
And
And I can't remember what time this was during the day, but I wanted to give you an illustration is if you sell this naked, at least at interactive brokers, this was the 3110. This was the market was, I want to say it was up right around 30.95 or so at this time. You could have sold that call for 170 and probably could have gotten in the middle of that at 175. And that would have had mathematically about an 85% chance of being out of the money. You would have tied up $13,500 in capital to do this. I thought that might be a little bit rich for some of the users. But IB in their options screen, and this is a pre-built, if you're an IB customer, they have what's called Mosaic, and you can open Mosaic.
different
This is a
browser. It's like
pre-built- Yeah, it's through Trader Workstation. It's just, and you can, mine has tabs for, I've got the short-term charts up, options trading, classic TWS,
yeah.
and long-term charts, and I can flip back and forth them. This is one of Interactive Broker's pre-built screens that you can use. So, you know, if that looks good to you, you can hit, there's a transmit button on the right. You can transmit it and it'll go to the market and you'll fill it. And then boom, they'll credit the money to your account. You keep the money that you sold it for. And if by Friday at 4 o'clock it's below 3110, you keep it all. Now, this one is that same. This is one on the downside. I put up some puts for this.
All right, I want to bring that up on the screen. Hold on. All right, I want to bring that up. Hold on.
Black Hat, was that enough for you, or do you need me to go through more?
You need to go through some more for me.
No, that's fine. And I can get shots from my screen. The market's open, so these things are moving.
Yeah, I actually, well, we'll get back to my questions. I have some questions I wanted to.
So this I was pulling up when the market had that big sell-off. I wanted to look and see, you know, what I could get. So
You mean when I was looking at this chart right here? You know, when I showed
Yes.
you the chart before? So this breakdown here, this is exactly what I wanted to ask you about. So let's go to my question first, and then you're going to explain it with your example. Market drops off like this. When you get a reaction on news that you know is news and it tends to rotate back up to the scene of the crime, quote, or term, how do you approach that? Are you talking about that right now in your next example?
Well, I think it would be, if you're going to do this as an intraday, I think your spies or buying spy calls would be better than my theta.
All right. But the technique?
The technique is the same.
All right. So you could go through that.
Yeah, I'm looking at more. I have to admit, these days the market is moving at an average about 25 points a day up and down.
Yeah.
So what I'm looking for is if we're down 20, down 14, up 14, if we, you know, that was a 10-point move, and that's why I pulled this set of options up, because I wanted to look at something different, because I had the ones under it up there. At that moment, I could have sold the 3060. I could have bought the 3065. So instead of a naked put, I'm laying out a put spread. This is called a bullish put spread. That means I expect the market to go higher, but I don't want to tie up as much margin. So I'm buying that 65. That means now it's showing a slightly different number because it's registering my call spreads. But for futures options, it's half the width of the strikes.
Did I lose that?
Or if it's 5 strike, you know, take 60 minus 50, or 65 minus 60, it's 5. Multiply that times 100 and divide it in half. So your margin impact is 250.
That's not bad.
So if you had laid this, well, there's a trade-off. You could have gotten about 70 cents for that spread, and you would have had about, if I remember right, the delta on that's what, 18. You would have had about an 80% chance of keeping that, but that 70% is only $35. So, there's a trade-off when you don't use this, when you reduce your risk, you're taking on less risk, you're rewarded a little less. But it's like someone dropped a $20 bill in front of you.
Yeah.
And it's free. And every time someone drops a $20, $40 bill in front of me, and I have an 80% chance of picking it up and keeping it, I usually take it. Steve, that trade would have made $35. It's not a lot of money, and it's not the amount of money I'm concerned about. It's the methodology. Again, if I have an 80% chance of keeping that $35, that's of interest to me. Eventually, as I get better at that, you could scale it. So, when you get to $20,000, you could throw 30 of those things on.
Is Tight Stop still on here? I think we lost him.
Rob, you still here?
I might have to call him back. I mean, he would have gotten in the room and said, "Hey, Johnny, I need to get back on." I wonder if he's swiping.
Now, I will say that my heating and air guy apparently is on his way. So,
Oh, I do see him on here. It's just that something happened before. Oh, there he goes. Now he's calling, I think. Let me add him. There we go.
Heard you, smartass.
That was code swiping.
No, I wanted to add to what Keldar said.
Yeah, no, I know you were looking forward to it, so I wanted to make. I didn't know if you were still on or not.
What you have to understand, what Keldar and I both do, and I do it mostly on stocks, and he's doing it obviously on the futures. With a two-sided market, whether you're bullish or bearish, there is an edge to selling premium.
There we go.
Just based on options in general, the characteristics of the options, there is an distinct edge where you should sell premium. Number one, we know about time decay. Johnny.
Yeah.
I'll post a picture of what time decay looks like again.
Yeah, let's do that. Because that really got my, I understand what we're talking here probably about a little two different things, but I like the way you explain that.
So while Keldar is giving you his example, show this chart.
All right.
I just put it in the main room.
All right, I'm going to show that right now.
And this is one of the key points why we sell premium.
All right, hold on just 1 second here. I'm going to get it set up here. Skype lines are open, DayTraderRockStar. I have to look at my Skype thing to okay some people, but we're going to go to that chart here now. I want to show you that chart that Rob had sent in here right now. It's right here. And go right ahead, Rob. It's showing right now.
So we always talk about if you're going to trade, the best way to trade is find yourself an edge.
Yeah.
Well, this you're seeing on the screen right now, as far as option premium, this is your edge. This is one of the key components. There's two. There's two things that are very important about selling premium. Number one, there's 3 guarantees in life: death, taxes, and option premium decay.
Yeah, that's
just as what you see on the screen right there. From 90 days until expiration, it makes a exponential move. It expires exponentially. And that where it's circled there, that's the last week. That's when I look to get in with between 5 and 0 days left till expiration. Just for the fact of that chart that you see on the screen right now. That's the main component.
Gotcha.
Now, there's another facet to this selling premium, and Keldar touched on it, and a couple people asked.
Order filled.
Order
canceled.
Your profitability is limited to improve your probability of success. So because it's further out of the money, you're going to make less, but the chances of you making money are percentage-wise
Higher.
exponentially better.
Mm-hmm. Well, welcome, Switcher, to the show. I think.
Hi, guys.
How you doing, Switcher?
What's up, buddy? Long time no speak.
Yeah. Johnny, you got a chart of Boeing for today you could pull up?
Sure thing. Let me bring up that Boeing chart here. Good to hear you,
Vinny,
Switcher.
You were asking about calculation of intrinsic value. I don't really care. I'm just looking at the math on how close I'm going to be in or out of the money.
That's it. That's really one of the only numbers I look at as well.
You know, I don't care what it's worth. I care, can I make my whatever dollar number that is? In my case, I'm generally shooting to grow that account a 0.5 to 1% a week. So I sell as many options as that is to get to that number that I have an 80% chance of doing.
Is there like is this becoming just a machine for you, Kelder? Like a business? You know exactly what you're doing. There's no emotion involved. You know what to pick. How do you? I mean, everything's defined.
It's pretty simple, Johnny. At the beginning of the year, I put $100,000. I put it in an account, and I started doing it. Anytime the market moved more than 0.5% one direction or the other, I sold 80% options, and I'm using Thinkorswim to calculate that.
Okay.
Right.
More so than the delta, and I sold those usually the nearest expiration where I thought I could make more than $40 per unit, basically.
And how would you figure that out? Or just look at you would do the calculation.
If I look at it, I'm selling it for $1, I'm making $50.
All right.
If you're selling it for 80 cents, you're making 40, and so on.
Because
again, they're half the size of the stocks.
Well, you did a great job of just outlining your whole strategy there. I appreciate that.
So somebody asked me what happens if it goes wrong, and I'm posting a chart in that. You do what's called rolling.
All right.
So this is that same 30-10. I mean, I've set this up as a call spread.
Switcher, I'll get to your chart next.
So if on Friday, let's say on Friday it's trading at 30.15 and you're concerned you're going to have to not, it's in the morning, you don't want to worry about it. Well, you would look to buy in your 30.10, you'd sell your 30.15, and then you would sell the 30.10 and the 30.15 for next Friday. You would take a small loss on the front one, you'd get money back on the second one. In this particular case, you could have probably rolled that out for $1. And you'd extend yourself for more time until the market comes back.
Wow.
And again, Keldar is selling calls. He's collecting that money up front. If he's wrong, he gives part of it back. When you buy long calls, so Keldar is bullish.
Uh-huh.
So if you want to do the opposite and just buy calls instead of selling puts, you have to lay that money out of your pocket as opposed to collecting it up front when you're selling it. And again, there is an edge to selling premium.
Yeah.
So the market right here is at ridiculous pricing. Everybody and their brother is trying to step in front of this and pick the top. And I agree with them. The market should, we've moved 100 points in a month. But at least this way, by selling calls against it, I'm getting paid to wait, whereas everybody else is putting money out. And, so I lose every now and then. I roll it forward. But,
Yeah.
I try to go further out so I don't lose money. I'd rather make less money and not have to worry about it.
Well, let's Switcher. What I have the Boeing up here, and then I have a good question for everyone on the line here. Switcher, what are you looking at here?
Yeah, I just these guys are so smart, man. I don't want to steal their thunder, but we're talking earlier about just an intraday option, and so I just wanted to give something to some of the listeners.
Yeah.
That may be looking at some of the stocks that you've got up, which I'm watching. Can you go in on just today? Look at the hourly by chance?
Yeah, sure.
So you may recall we were talking about this, and Anthony might have chimed in, I chimed in, and right at about at 1:30. Where's 1:30 on there?
Right. That's 1:30 is right Right. Well, this is an hourly. That's 1 o'clock, and that's 2 o'clock when it starts.
Yeah. So look at like
That's
at one,
60. Yeah, that 60 period was starting to roll over a bit.
Can you go not 60? Could you go like, I don't know if you can get
15.
minute.
I can get 15.
Can you go minute?
Yeah, I can go minute. Let's go back to it for a second. I'm gonna have to scroll back to it. So what time you want? 1:30. All right, here.
1:30 in the afternoon.
Okay.
130 it bounced.
Yeah.
A little bit.
It was a nice divergence, actually.
Yeah, so here we are. We're it's on the screen. We're watching it drift. We're talking in the room, and then all of a sudden I go, you know what? I think market's going to turn around. I think Bone's going to go with it, right? Because it's a momentum stock.
Oh yeah.
So I looked at the weekly, the November 15th, 262.50.
Oh
And
nice.
I bought one call at $2.90.
Nice.
So my outlay is $290.
Yep.
I sold that call at $150. So we got about a half hour later. I
150.
sold it for $3.80.
Nice. It's amazing how fast they
I took
moved.
$90,
Tradometer
right,
ES oversold.
on just a momentum stock that just seemed natural flowing with the market.
Tradometer
And if you do the 90, and this is back to what I was saying earlier, percentage return. If you do, 90 over 290,
You gotta be
that's
like.
pretty good for a half hour's work. You
Yeah.
know.
Oh yeah.
That's exactly what it is. And you picked what were the options again you had on that? You picked.
I picked the weekly, so the November 15th.
So
the
expiring
262
on Friday, right?
Yeah.
All right.
262.50. And so obviously Keldar and Tight Stops here, they're looking at a little bit more time.
Yeah.
But some folks might be in the room sort of just like, because this was a stock we were featuring today, we were covering it, you get comfortable with it, we're watching it.
And it had a
This is already
divergence
sort of
too.
trading
Did you take
with
that on the
the-
divergence? Sorry to cut you off, man. I'm just looking at how nice that divergence was. Did you take
Yeah,
that?
like that. I mean, everything just sort of lined up.
Yeah.
And we're all talking, and we think the market's going to go up, and here we go. So it's a momentum stock. It's
Yeah.
going to go.
And from this point to about what time did you trade it to?
I bought it at I bought it 124, and I sold it at 150.
All right, so yeah.
Do you
So, like-
bought calls?
He bought
It was calls.
yeah.
Yeah.
So he got, it moved up. Yeah, that's beautiful. I don't have the option chart up there, but I'm sure that, like you said, it's like probably a 40% move you got.
Yeah, and it was like in a half hour.
And a half
it just
an
felt
hour.
so natural because the market just started to go up by a couple of points, and the momentum stock went.
And I have to point out, I know we all love it. Look at that divergence. Look how steep that was. That was awesome, Keldar. That was awesome. I mean, God, how did I even miss that divergence in that?
That's why I come to work.
Yeah, that was great. Great example. That was good. So, so I got a note from Screen Tan this morning. He's making his because he can't wait to get down to New York and meet up with everyone. He wants to come down. He's hoping everyone's going to do the get together this March.
Annual pilgrimage.
Switcher is probably one of the highest people on my list that I love hanging out with.
Okay, well, I'll be coming down for sure. So.
Me too.
Awesome.
So-
Rob, you're man, we're blood brothers.
Yeah, so get your dancing shoes ready. Get your microphone ready for karaoke. We're gonna do it right,
Oh, awesome! All right, so good.
Okay, I'm gonna drop off because I want to listen to the real experts in the room here. Listen to these guys
I know.
more. But I just wanted to share the quick intraday where if you're following along in the day show and we were covering this, you can come along with the party.
Thank you, man.
Okay, guys.
See you
Good
later.
luck.
Bye. All right, so sorry about that, but that was a great example
No
there.
worries.
Right.
No,
again-
and
Keldar and I are betting on the fact that if the market in general goes up 53% of the time, he's placing bets, and so am I, that have 80 to 100% chance of success.
80 per 100% chance. And does that, again, I might be just, I don't know, on too much sushi right here, but is there an indicator to like just say what the percentage of this trade is going to be? Is it just on the
It's
Thinkorswim?
on toss.
It's only on toss.
And
Yeah,
Keldar
and-
takes
well-
the opposite of me. He does percentage of in the money. I just do out of the money.
All right.
So here, show this example, John.
All right.
I'll put it
yeah,
in chat.
I mean, it's just the opposite of thing. Whenever the other one, add or subtract 100 to it. I mean,
Yeah.
basically we're looking for high probability trades.
Yes. All right, I want to get that up for you, Rob.
You know,
I
in the
always
money, out of the money is the same thing.
So this is one that I laid out today. This is a put spread. It's way out of the money, but I'll explain it to you, and all the details are on the screenshot.
All
There
right.
you go.
Go ahead.
All right. So you can make that a little bigger, maybe.
Yeah.
There you go.
Is that
All right,
Amazon?
Yeah. So we're looking at Amazon, and I was, today is Wednesday. We know option premium decay is starting to kick in. I usually wait until Tuesday, 11 a.m. before I'll sell any puts.
All right.
Unless the market is screaming and I don't think the stock is going to sell off at all, I may sell them earlier and try to make up some extra decay
Yeah.
in the form of time. But in this case, and Amazon dropped about $10 from where I put it on. It was about 1763 at the time. But I looked at it and I said, right now Amazon has an average true range of about $26.
Okay.
So with 3 days to go, you figure a normal move, this thing could move 75 points.
Yep.
So right now I sold. What I did was I sold the 1635 puts.
Okay. 1635. Would that give you? And what was that? 30? It was at 70. No. What was the price at the time?
It was at 1763.
63. And you sold the
1635s, which are about 130 points out of the money.
Oh wow, 130 points out of the money. All right. So how much do you have to put up for that, and how many contracts and et cetera?
All right. So the thing is, because it's already Wednesday and it's so far out of the money.
Yeah, it's got to be.
Like, all right, the least I'm gonna take out of this thing is $200. So I saw there was a 15-cent bid for those. I'm sorry. There was a nice bid out there. I figured it wasn't going to drop 135 points by Friday, so I sold the 1635s, and I bought the 1600s as protection. So there's a 35-point spread there. When I sold the puts and bought the puts as protection, the net resulted in 15 cents credit.
Okay, per contract, 20 contracts, 300. All right, awesome.
So I did 20 contracts. The maximum I can make on this is $300.
Okay.
Now, when I sold those 1635 puts, it had the percentages where it had a 98.8% chance of closing
98.
above 1635
Wow.
with 3 days to go. So if the ATR is like 25, $26, call it 25. A 3-day normal move would be 75 points.
Yeah.
Well, people say, "Oh, Rob, but I've seen Amazon drop $50 in an afternoon."
Yeah, but not in this market.
That is true. I've seen it go down 120 points in 2 days a few weeks ago.
All right.
But the math is telling me that all things considered, in a vacuum, this thing is not going to drop to there. Now I'm only making $300.
Yeah.
My margin requirement is $70,000. But the thing is, that's just so I can play in this thing. Otherwise, if I want to buy 1,000 shares of Amazon, it's going to cost me $1.6 million.
Yeah. No, I get that, but I don't think
have that.
you still think that 70,000 to three. What was the potential max gain? $300 is a good bet. I mean, 98% probably. But let's see. What are those?
Okay, but look at that. It's not just that's for that day. But let's say, for example, it does end up a little underwater going into that day. He can always roll that out for.
Mm-hmm.
Right.
Yeah.
John, it can make a hard, fast sell to that 1635 level. But again, by Friday.
When you start, the only time you start
So
losing money on this trade is when?
if it goes below 1635.
So as it gets down to that level, how does that
Right.
trade? Can you get out before that and not lose any? I mean, you're losing money, right? Or do you lose it
No,
all?
not necessarily, because I'm hoping that I will make more in time decay than I will lose.
So
point-wise.
say, for an example, You're in this at the beginning. You have how many points you have? 130 points. And you bought this and you put up $70,000, and now it's moved down and it's only 50 points before D-Day or whatever.
Right.
How do you get out of that, and how much would you take as a loss, or you don't take a loss? I mean, what I'm saying is, if it starts moving down to unless you have protection, so you have the protection.
Yeah,
which
most
is gonna,
I can lose is that 35 points.
so 35 point. Yeah, the most you could lose, and that's if it just crosses underneath that level at the close. But if it gets close to that level, are you gonna?
I would probably either lock in a small loss.
Yeah.
But again, I normally when I lay these out, the goal is not to ride them out to expiration.
Yeah.
It's just to take the meat of the decay out of the trade.
Yeah.
Yeah, and for stocks that the general philosophy is like take it off with a 50% gain, and I'm writing my futures contracts. I'm trying to get myself in a position that the theta decay is extremely quick, so I don't worry about that as much.
Mm-hmm.
I rarely take mine off.
In this example, I probably wouldn't take it off early, only in the fact that I only collected 15 cents per contract.
Yeah.
So if I take it off at 50%, I only make $150.
Yeah.
Whereas if I really don't think this thing is going to sell off, I'll let it ride.
Yeah.
And hopefully I can buy it the morning of expiration, and hopefully it's still 100 points out of the money by then, and then I won't even bother. But once you get the meat of the trade,
Sam, I agree. So he's saying, how many traders have the trade to put up that type of money, though? I mean, this is to make $700. If you have a few $1,000s, say you get into the market as a new trader. I mean, this is great. I understand it, but give us an example that someone with $5,000 can make some income.
All right.
Okay, but he could have put on. No, but you could have put on that trade with $5,000 and made $35
correct.
with the spread.
I could have did less contracts. I could have did a tighter spread, and I could have did it closer to the price that it actually trades at.
Guys, I'll be back in just a minute.
All right, thanks. Hold on. But then you tie up all that money just for $35.
Well, in this case, 300. But yeah, again, it may not be the best strategy for you. If you have a bigger account, it helps. If you have a smaller account, you might not be able to play in Amazon. You might have to play in something a little cheaper, like the Grubhub that we did.
Yeah. I had a question here. I mean, this probably could come later in the thing and keep the roll on here. But one of the questions I was going to ask you and Keldar is, up at these levels, how would you approach taking some protection in your longs at this point? If you were going to, all the volatility, you want to maybe have a bet of potential bad news coming out, whatever, something going horribly wrong with trade deal and stuff, and we have a downside, but it doesn't cost that much. We have good protection, doesn't cost that much, and we can continue to hold our longs. How would you approach that?
I would just buy some puts.
Yeah. All right.
Keep my long, keep my stock position, and buy some protective puts. And if you think it's only going to be a short drop, if there's a pullback.
All right. So that's what that's the way I usually do it. I'm just.
Yeah.
Just wanted to
I hear you buying puts, you have a lot of stock positions. You're like, to hedge myself, I'm going to buy some puts in case the market jumps, which is great. And they always say, buy protection when you can, not when you have to. So when the market is going up, puts are much cheaper. That's when you want to buy it.
Yeah. Well, yeah, same thing with.
Want to buy puts.
There's the old adage I totally believe in. You want to be short in the tops, not short in the bottoms. Not the as it's breaking down, it's usually time for a balance. But if it's busting higher, you want to be selling the strength and buying the weakness.
Yes.
Yeah. 100%. I mean, that's the only way you're going to catch the top, and the only way you're going to catch the bottom is to step in to that gunfire.
We got any football fans in the room?
Oh, God, yeah, I'm sure.
Okay, well, the best example of selling premium is the 2-minute warning.
Good example. Nice, I like it. 2-minute warning means...
I love my example of selling rotting fruit, but the 2-minute warning is what I'm doing on Thursday and Friday. I'm up a touchdown with 2 minutes to go, and I'm playing defense, and I'm looking to press my bets when I can.
Nice.
So I always trade on Thursdays and Fridays for this reason that we mentioned, time decay. I can't impress upon you enough with time decay.
And you started on usually Wednesday or Thursday.
Well,
Best
I
time.
don't sell them usually until Tuesday of that week of expiration.
Yeah.
Because at Tuesday at 11 a.m., that's when the options start to adjust down.
Now, why is
I
that?
told you the market makers got smart. They adjusted their prices on Fridays and Mondays.
Yeah.
Because people like Keldar, for example, does a 5 or 6 day trade that carries over a weekend. It used to be when the weekly options first came out, guys would sell premium on Friday. Come Monday, they already had 2 days of the market being closed. The clock was ticking. Nothing was trading, but the clock was ticking. So they were scooping up that decay by Monday. So Boeing closes at 362.50 on Friday. And you have the right to buy it at $360, right? It closes at 362.50. You have the right to buy it at 360. Come Monday, if it opens flat, that $360 option is going to be worth less just because you lost 2 days of time for the weekend when the market wasn't open. But the market makers got wise, and they caught on to that, and they say, why the hell are we losing so much money? So now they adjust their option prices on Mondays and Fridays to try and pick the pockets of those people that are trying to do what they used to do. So I wait until Tuesday, and then that means I usually only have 3.5 to 4 days of decay to worry about.
So,
and I will pick a bigger stock like an Amazon, and I look at the ATR, and I try to double it.
Yeah.
In that time frame. So if it's make about a 75-point move, I'll maybe try and find an option that's 150 points out of the money.
Yeah, and this is tight stops we have on here. This is Rob. So Rob is he worked in the financial district for a while.
And I'm back for a little bit.
And his Keldar's coming back. So we're
again,
go ahead.
Limited profitability to improve probability. You're willing to make less money for a higher percentage chance of actually being successful.
Okay.
We were talking. No, go ahead.
Go ahead.
No, I was just catching Keldar up what we were talking about, but we're good.
And the beauty with selling premium is you can take on as much or as little risk as you want. I choose to go 120 to 150 points out of the money in Amazon because I know it's a monster, and there's still decent premiums for an $1,800 stock. Now, you're right. If you have a smaller account, it's going to be harder to make Amazon unless you're closer to the price when you lay out the spread. Or you have to put a tighter spread. So I have a 35-point spread in the example that you showed on the screen. You might only do a 10-point spread.
Yeah.
Or a 5-point spread.
Right.
Yeah. But basically, your margin on a stock is the difference of the spread. Times $100. So if it's $5 spread, it's a $500 margin.
Correct. So 20 contracts times 35 points is 70,000. So yes, you say again, you're risking a lot of money. I'm not risking it.
You're not risking it, but you're tying it up.
I'm not letting it get to the point where I'm risking $70,000.
Yeah.
But I need to use $70,000 worth of margin to be able to do this strategy. But again, it's cheaper if you're making a bullish bet.
Yeah.
If I'm going to buy 2,000 shares, it's $3.6 million out of my pocket.
Yeah, sure.
But if I sell 20 contracts and buy 20 to protect myself, I'm putting up a hell of a lot less money looking for the same result, a bounce in the stock. and you can do it intraday, depending on where it falls in the week. My favorite days are sell-offs on Thursdays and Fridays, especially Friday.
Well, this week's
I
like
like
gonna be
Friday, so you can sell out for Monday or like for the futures option.
So let's use this for an example, Keldar. I mean, we're coming up to an interesting market's at the highs. Say we get a selling, we have a day tomorrow we're gonna feel like we're very bearish. How would you approach tomorrow's as a bearish day?
Well, if
You're starting getting up in the morning, markets are down 10 points
the
already.
market's down, I'd like to see the markets down 15 or more.
All right.
Me
and
too.
Then I would get excited, and then I would probably be looking to sell something in the 30, 40, 30, 50 area. I may, because of the risk of the there's some structure underneath that needs to be addressed. But if we get under 30, 60, we can get down to 30, 40 pretty quickly.
Yeah.
I might do that as a spread, but I'd sell something like 30, 40 and buy the 30, 35 to protect that for next Friday or this Friday with the existing calls I have.
All right.
Johnny, I salivate on Thursdays and Fridays.
Yeah.
When there's a market sell-off. And why? Because I'm looking to make a bullish bet on a bounce. How many times have you seen the 950 reversal ends up being the low of the day?
Oh, so many. I was just going to say that. Yep.
So, like Switcher said, he's just buying calls for a bounce. If I think the market's going to bounce, and in a stock like Amazon, if it's down 15, 20 points, the chances of that thing, because we know with gaps, they normally fill the gap from the previous day, that next day in the morning. And those usually the ones that gap down and run turn out to usually be the best performers of the day.
Yeah.
If you catch a 950 on a Thursday and sell premium, or 950 on a Friday, those things are going to quickly erode. That premium is going to come out of it so fast, it's going to decay.
So you still want to do that even if it gaps down, you're saying?
Yes. I love a gap down.
Yeah.
Because I'm a counter trend trader. I'm looking for the bounce. I'm looking for the divergence or the 950 reversal or off of a Keltner. When I get a sell-off, I start to salivate, especially on a Thursday or Friday, because I know that drift down in the market will probably be short-lived, and I'm going to pick a strike that's pretty far away from that price.
Yeah.
But as the market's going down, all of a sudden those put premiums start to, bids start to pop up. Premium prices start going up on the puts as the market's going down. All of a sudden when that thing bounces, those bids evaporate.
Uh-huh.
So I look to hit those bids.
Yeah, all right. That makes sense. So maybe we'll watch that for tomorrow.
And I just want to get back a little bit about the amount of money. I mean, I posted that chart with that spread trade in there, which was, selling the 60-65 put spread. That trade, you would net about 30, 40 bucks, 35 bucks, and you would tie up $256 in buying power. Okay. That's not that bad.
That's not bad. No.
For about 5 days of trading. And the concept is to get your head around options premium will decay as long as you stay away from price as it gets closer to expiration, and to training yourself to look. It's kind of a methodology. You're looking to let the math work for you. And with these future, you can open a future account with a futures broker that'll let you trade options for $2,000.
Yeah.
As long as you're trading spread. So, if you could do one of these spreads a week and you can do 30 bucks a week on $2,000, well, that's not bad money. If you think about that, that's what, 0.75% a week.
How often do you trade, take a position to make your 1% that you're looking for a week?
Pretty much every week this year.
So, I mean, how many trades a day? How many trades a week?
One or two.
One or two.
Yeah.
Do you think? I mean, do you think you want to start posting those and like put a little special little indentation saying this is my income, this is my trade. I trade once a week. Have you been posting those?
Yeah, I've been posting that I'm taking options and put positions in the
Yeah,
futures room.
because that's not that's a nice little
And
you're
I've talked about this strategy in the futures room.
yeah
The thing is you have to be paid with what this strategy is. You need to wait. You can't just say, oh, if it's only 10 points away. Well, 10 points isn't much of a move these last few days.
No.
You want 15, 20, 25, 30 points, and then you can start getting really excited about counter trading and find a high probability or high percentage place where price has to either really get smacked down to you or really rise up into you.
yeah
And especially, like I said, especially right now where the market is, by a lot of different means pricey. There are all sorts of reasons this thing should be selling off. I'm not smart enough to guess when that's going to happen.
well
So
yeah
rather than pay to have protection to the downside, if I'm selling these calls against it, I'm getting paid for it to happen.
when you
Does
were
that make sense?
yeah when you were just taking a break before I was asking Rob, with the markets up at this level, how would you approach taking protection in the markets? Like, you have positions
Well,
that you like, the Rokus, the McDonald's down here, but we know that the market has the potential of flushing at any moment. What would be your strategy to protect your current longs?
well, what I did was a few weeks ago, I sold a VXX 18 December put, so out through December 20th. That's the monthly. And I used that money. I got paid 93 or 94 cents for that.
So tell me
And I
that there was
used
a sold a VXX. Which one was it?
December, it was the December 18 put. And I
18.
sold this like 2 weeks ago.
All right.
At the time, the VXX was around 1945. I didn't expect it to get as low as it has. It's just truly amazing. And I used that money. I got paid like 94 cents, and I bought a corresponding on the same date SPY put. It's a 271, and I paid 93 cents for it. So essentially, I have downside protection because if the market pukes,
Yeah.
that 271 put will go up in value.
Yeah.
Risk.
The VIX will go higher. And essentially, so I have protection to the downside that didn't pay anything.
Yeah.
Now, my risk is right now is if the VXX gets below 18, I will own the 100 shares of the VXX at 18, which I'll probably just immediately sell around because it really doesn't move that much. I'm sure I can get out of it, but that is one way to do it that literally was free.
Nice.
So if you get one of Trump Sundays where we're putting tariffs back on and the market routes 75 handles, those 271 SPY puts for December are going to go up high, but it didn't cost me anything to put on.
Nice.
So my entire portfolio is hedged for free. Now I'm tying up $300 in margin for each of those VXX puts, but still I think I'm okay with that.
Yeah.
It's not like I had to really put out money. I mean, I think buying puts up here is not a bad thing. I think if you have long stock positions, selling calls against those and do covered calls with the hope that you don't really get called away but just keep the money isn't a horrible thing. Rob probably has some better information on some of that stuff.
Oh, man. You speak for hours.
Yeah.
But like, for example, in this Amazon, it closes at, call it 1750. If I wanted to, at the end of the day, I could have sold a 1700 put and collected 81 cents. That still has a 93.76% chance of expiring worthless. But with 2 days to go, the ATR in Amazon is 25. That's a 50-point drop there in 2 days if it wants. And then I start squirming in my seat saying, oh, shit, I collected more money than I probably should have. And now I have all of this risk.
For those that don't know what ATR is, that's average true range. That's basically how much does an underlying instrument move in a period of time, up and down. You know,
Right.
that's why when I'm looking at looking at the futures, I'm looking for it to have moved in a position in a direction that's beyond its normal daily range. The ranges have been a little extreme even over the summer, but usually the ES used to only move about 10, 12 handles up and down.
And I'll tell you what, when an Amazon is down $50,
That's a big
you
move.
see lots of option activity. And even though it's scary, with the market down $50 and Amazon down $50 or $60, that's probably one of the best times you want to jump in, as scary as that sounds. Because as the stock is going down, all of a sudden, these put premiums, the bids start popping up and they start going wild. When that thing bounces, they evaporate.
Mm-hmm.
Those bids won't be there anymore. So if you're paying attention, you can capitalize on it on a slide.
And I'm going to say something about the for those who have IB and can pull up that option screen. I have that almost in direct line of sight of it's on my trading rig, but next to some of my other stuff. It's funny how you can watch this stuff during the day and you'll see these options chains get busy. If the market sees something news,
You mean the changing of the colors, like the Christmas tree lighting up?
Well, you'll just see lots of action on it where, lots of bids and asks are changing dynamically very quickly. That's usually a good signal that something's going to happen. It might not tell you what's going to happen, but it's a time for you where you should get your spidey senses up and be paying attention a little more. It's a little finesse to kind of learn it, or keep an eye on it, but it is something that if you watch it long enough, you'll kind of get some feels on how things are working. If the market's stable, it's pretty flatlining. It doesn't move that much. If the market gets really jumpy, you'll see this thing dance.
Hey guys, have a question for you, and I hope I didn't think about asking this earlier, and I'm in this position in AUPH. I've been following it a long time. I do believe in it. I think that they're going to be coming out with some good FDA news within the month, within 30 days. I have 4,000 shares. The cost average is about $530 and change, and I have about 30 options that go out to about February. I did not take any protection. They're going to have earnings tomorrow, but the real news is going to be coming out with the data when the data can. So if it pulls back a little, I'm going to probably buy some more. But how would I predict? What would be the best way to protect that? The cheapest way, but the best way to protect my 4,000 shares in AUPH going into the end of the year, where the news should be out before the end of November.
I would say to play it safe, I would buy yourself some January protection 65 days from now. Give yourself a little bit more time.
Okay, hold on. Be back in a second, guys.
Yeah. So explain that to me a little, Rob. So you were saying buying. What was that? What I didn't hear what you're saying.
So I would think if you're expecting the news to come out, say at the end of the year.
No, I would expect the news to come out before the end of the month. But yeah, we'll say end of the year, before December. Definitely in December.
Okay. So I would say to buy the Januaries. Buy yourself a little bit more time.
So I'm buying the January puts.
It's trading at what, 535 now?
I have to look.
Yeah.
All right, so let me take a look. My options. So I'm going to go out to January. They have the monthlies. Which price strike?
I'm looking at the 4s, John.
All right. So
but I'm thinking maybe you want to do closer in case this thing, maybe the 5s.
Well, the 5, yeah. I mean, I think if it failed, I think it would probably come down to $3 easy. If the worst case scenario, $2 to $3 between those two. Of course, I don't want to take that. I don't want to. I would crush my options anyway. I'm just looking at a way of just protecting myself, a cheap protection that I could throw in.
I'm thinking if you buy the 5s, even right at the money almost.
All right, so you're buying the puts.
Buying the puts.
Mm-hmm. About dollars, so say $1.70.
Yeah, but the thing is, you own 4,000 shares though. To buy 40 contracts of that, you're going to spend almost $8,000 in protection.
Yeah. That's a lot.
Yeah. You don't want to really sell calls on it, especially if you're expecting good news or good earnings. You never want to sell. Well, I scratch that. You don't normally want to sell calls against something you expect to go up.
Yeah.
I was going to say you should sell covered calls against it, but you're expecting a pop on good news and
Down the
results.
road. Yeah.
Hmm.
I mean, sometimes it's just when it gets that cheap, it's not much you can do, right?
Yeah.
You know, when you
It's a
talk.
lot. I mean, you could buy partial protection, John.
Yeah, I mean that's what I was thinking. Maybe just partial protection, so I don't get. But
Maybe
then I
buy
don't.
20 contracts instead of 40
Yeah.
as protection. Oh, it's kind of tough.
All right. Well, at least I'm not missing anything obvious.
No, not at all.
Yeah.
And you don't necessarily have to go out to January because you're paying more money. Not much, though. For a month's worth of time?
What is he buying the puts, or is he? What was he selling calls against it?
I wasn't
he's
doing
talking
anything.
about just buying himself some protective puts. But unfortunately, if he wants to buy, he owns 4,000 shares. So if he wants to protect himself and buy 40 puts, it's still going to cost him almost $8,000 if he buys the 5s.
Okay, but he's at like 550, right?
535.
Well, why don't you sell the January 8th?
Well, I don't. That's what I'm asking. I'm not.
I mean, you're looking for protection for the downside. The worst thing is it goes to 8 and you only sell it at 8, in which case you made $4 on that because you collect somewhere around $120 a piece on it.
Yeah, you know what, Keldar, you make a good point. So if the January 17th, 65 days from now, the
Right.
January 8 calls.
January 8 calls. All right.
If you sold the 8s against it, you could collect almost about $15,000, John.
15 if he sold, he's got 4,000 shares, right?
Yeah.
Yeah.
Plus, I have a lot.
Okay.
Yeah.
Well, so he'd collect about $5,000, right? 5.25. Or the 8s are 110 bid, 145 ask.
3, 4. No, it'd be about $16,000.
I don't get that math. I got it, man.
Wait, 370 times 40. That's about $15,000.
What are you getting 370 from?
Because the January 8 calls are 370 by 410.
No, they're $1.10.
No, they're $1. The 8s are $1.10 by $1.45.
45.
Out to where though?
January
January
17th.
17th.
January.
65 days away. The $8 calls are 110 to 145.
Oh, I'm sorry. I was looking at the puts. No, you're right. Okay.
So let's say he splits it and gets like 120 a piece. He could still bring in 4,800 from it. And the worst case that happens, well, it goes down a little bit, but if it gets caught, if it ramps up after the news, he'll still get another, $3, 2.5. He's in like at 550 plus whatever he just collected.
Johnny, if you want to make some extra income, those 8s have an 82.3% chance of expiring out of the money.
Wow.
So it shouldn't reach $8.
When something like that has a like a binary event, an event that they finish their trials, they said it'll be within a month they'll have the results out. Does the options tend to price in that event or not? Because it doesn't seem like it's priced in that event if there's such a big percentage to a downside move. Like, does it recognize that? Does that get in the formula? Because how does the that decay come into play when there is such a big event on deck that could really, you know where I'm getting there? I don't know. Is it somehow priced in?
Well, okay. The implied on that same toss out thing, the implied volatility for those Januaries
Huge.
or even the Decembers are like
Huge.
220% up to 360.
You
Depending
got to
on
sell the
strike.
premium, John.
Yeah, you got to sell the premium.
Remember how Jody Wody
So-
asked the question last month? She said, don't you want to sell implied volatility when it's high?
Yeah.
AUPH is off the charts.
It is, and that's because of the event, right?
Yeah.
So does that tell you anything? Does that tell you that a move is coming that could be positive or negative, or it's just a move, that implied volatility?
It's just there's going to be a move involved. There's going to be a move involved.
Yeah.
Doesn't necessarily mean, because the current IV percentile is 95%, that this thing is going to go to $8.
But if
it doesn't work like that.
But look at the calls versus the puts on that same month. There's nothing on the puts, and there's tons on the calls.
Let me switch over. I have it set up to the probability of out of the money, where Keldar has in the money.
Yeah.
Yeah, but hold on a second. I'm uploading something for you to put in the chat room, Johnny.
All right.
It's on. I wanted you to.
But again, John, we mentioned this today on the air. In every month, that strike price of $6 had big volume today, or had some kind of volume in it today.
Yeah.
The Januaries, the 6s traded 1,162.
Yeah. December's
today.
had a big move. The 6s.
December was 1,082 contracts.
Yeah.
Now, granted, the open interest is very high in these.
Yeah.
So there's no unusual options activity, but there is volume in that strike across the board.
Okay, I'm putting this in the room, Johnny. Something I want you to look, and this is something with options volatility. For those who click on this, if you look at January on the far left, it's implied vol. And this is a really big drop off. So if you look at the $4, or let's say the $5, the $5 in January, there's 251.6% implied volatility. Look at that in April. That's almost down 75%. So yeah, they're pricing something to happen in January. That vol is getting crushed as it gets to April.
Right.
All right.
But that's plus or minus, John.
Yeah, I'm just using that as an illustration of somebody
look at-
thinks something's going to happen, but no one. If you look on both sides, the implied volatility
Is less on the
pretty balanced.
calls than on the puts. The puts, it seems like the implied volatility is much higher, 220, 200, 200 and over 200%, where the same call is 30% or something. Right? Am I looking at that right? Oh no, I'm saying implied volatility versus. All right, no, never mind. Sorry, I was just crossed them. Never mind.
The volatility is higher on the calls.
Yeah.
For the 5, it's 251, and for the put, it's 227. So it's got a little bit of skew, but the market itself has a bit of. Well, normally it would have put skew, so that's kind of interesting, actually.
What? Tell me what you're thinking. What's interesting about it?
To me, that seems to think the options players think there's more risk to the upside.
There's more risk. There is.
Well, that to me that says that just barely they think it's more likely to go up than go down.
All right.
Because to me that looks like there is more purchasing of calls driving up the demand's going up, and it's driving up price, as opposed to the puts. There's not quite as much demand, which isn't driving up price as quickly. I may be reading more into that than there really is, but I mean, there's nothing dramatic out of it, but it is a little bit interesting because unlike the indexes usually have what's called a put skew. Puts are always more valuable than calls for the same distance from the strikes. And that's because the market is always afraid of the big sell-off.
Yeah.
The market is rarely ever afraid of the big rip higher. So there is more demand for the puts in the indexes, so that hence that drives prices up.
All right. So after everything is said and done, and we're looking at this, and we know there's a big event, there's even a possible buyout. They're saying, and me being long, going on the long side, the best option here for a little protection, or you would say, is to recap, because and then we'll move on.
For me,
Sell the 8.
I would sell the 8s. And what that means is you're going to collect the money for however many 8s you sell. You're hoping in reality that the market goes up.
Yeah.
So if the market does go up and goes above 8, you're going to sell your 4,000 shares to whoever at 8, and you're still going to keep whatever the other $4,000 or $5,000 you got for selling those calls at 8.
Oh, I got you.
So you're going to make the 2,500, 2.5 point difference between where you are now and 8.
Yeah.
Is that right? And another $1,000 on top of it.
So I had to buy about 40 of them then.
No, you'd sell if you own 40,000.
I mean, yeah.
If you own 4,000 shares of AUPH, you could sell 4,008 and collect $4,000 for that.
Not sell 4,000. I mean 400 or 4.
Yeah, you'd sell 400.
400. Okay.
Yeah, but it's $100 a contract. Move the decimal.
Yeah.
That dollar, whatever it is.
Yeah. So it's going to cost me $4,000.
No, you're going to get paid $4,000.
Oh, I'm going to be paid $4,000.
Correct.
Yes.
All right.
And if they take it away from you at 8, you're really selling it at 9 because you collected $1.
Right.
That's
And
a really good trade, John. And if it goes lower, go ahead. Keldar's going to tell you.
Yeah, I was going to say, if the price drops, let's say it goes down to 4, you're protected down to about 390, 380, something like that. Whatever. Well, if you sell the 8s, let's say between 110 and 145, you would subtract that from your cost average, and that would be how much you were protected to the downside.
Right.
Gotcha. The problem is, I think if the news didn't come out positive, I think it would break under that. I think it would be actually probably down to the 2s.
Well, okay. Well, let's here's something I'll give you. So let's say you sell the 8s, and you sell what is, I think the common thing in the math is 40 of those.
Yeah.
Okay. Well, use some of that money and buy, say, 20 of the 2s.
Yeah.
40 cents. Does that make sense?
Yeah, it does.
Say buy protective puts, Keldar?
Yeah, but basically he can get the puts. Like if he's worried that if it really tanks, it'll get down to the 2s.
He can finance the protection with the calls that he sold.
Right. Well, he could sell the calls and then, not necessarily buy as many puts, but he could buy some puts. Let's say half as many.
Right.
So he's already protected down to about $4. So if he buys, 20 puts at 50 or 40 cents, he's still coming out ahead in that trade.
Right.
So you've got protection to the downside. You're bringing in some extra money that you're going to keep either way. It's lowering your cost basis, and if it rips to the upside, you're going to make even more.
Okay.
John, you're not looking to make money on the protective put.
No, I'm not.
Those are just to encase shit, like they say.
Yeah.
That's your insurance.
Xerox, I would agree.
For it to trade above 5, but not above 8. So you collect that money and you still make the appreciation in the stock price below 8 or up to 8.
And if you're worried about it going lower, in theory, you could sell the 8s and use that to buy the 4s.
Yeah.
Correct.
I mean, you've got
get free protection.
there are a couple ways you can do this. I think if it really tanks, then those 2s will go up fairly dramatically, fairly quickly in price, enough that it would be worth you selling them back out. But I could be incorrect in that. This is not my stock. So
Yeah.
I'm looking at what Yamada and Xerox are putting in the room.
Yeah, the thing that scares me is, John, you're talking about a stock that could be cut in half on
Yeah.
just this news.
Yeah, that's what I'm scared of too.
Typical of some stocks, it happens.
Well, see, that's why I was saying the twos, because it lets him keep more of that 8 premium that he's selling.
Correct.
The twos would almost be cut in half. And I figure if it's going to drop that low, those twos are going to go up pretty quickly. If
John,
it's going to drop in half, those will double.
John, what's your thought overall? You're expecting good news. You think it's going to trade higher?
Yeah, I do. I do think it's going to trade higher. I would say 80%. 80%.
And I think Eldar is right. You buy half the protection that you normally would have bought.
20.
Maybe 20.
All right.
And maybe at a strike lower. But I would definitely sell those 8s. And again, it's only because the implied volatility is so high.
Yeah.
And I would look to sell the 8s at like maybe 125 or something, the middle of that
Right.
bid and ask.
Yeah, definitely.
Get a little bit of an improvement on that.
Yeah.
But Johnny,
So-
they got a new drug coming out.
Yeah, they got a new drug that's in trials. It's for lupus nephritis. It's a kidney disorder from lupus, and it'll be the first one coming to market. And we've been following the stock for a while, out of phase 2 into phase 3. Phase 3 has been successful so far, and they finished up trials, and they're just putting together the data, and that's it. We're just waiting on it. I like Steve. Steve is a member who's a researcher, and he has a big background in the corporate research world, and he's been researching this for a while. If you put me onto ARRY, explain the same situation and how that was being, considered for a buyout, and sure enough, I got in. Less than 2 weeks later, it got bought out. It was the best trade of the year so far. So I got into
Steve,
this.
where the hell you been, buddy?
Huh?
Steve, where the hell you been, buddy?
Yeah. Yeah, it got bought out within 2 weeks. I got into it. He's been calling that, and he said this one's going to be bought out too. And he digs into it real deep. He has a lot of good information. So I've gotten into it, and probably for the last couple of months, my cost average now is right around here, 530, and I got options going out, call options going out from November all the way to February. My Novembers are due for Friday. I have 25 of those. They're going to expire worthless. But the other ones, I just felt like I was too early. I was too aggressive on this. And now I know the whole story. I was just early. And anyway.
Johnny, I'm doing the math on this. If you could get out those 40 calls at $8.25, you'd bring in $5,000. If you took on 22s, you'd spend $1,600.
All right.
You'd still
$3,600.
Yeah, I mean, to me that's a no-brainer.
What it will say that again? Let me write it down so I can do it in the morning.
Okay, in the morning you want to sell the 8s, and I would see if you can't get out and get those for start at $1.25. That's about halfway between the bid and ask right now. See what those are in the morning when it opens, but I'd try to get somewhere around that range. And then see if you can't buy the 2s at somewhere around 40 or 45 cents. Get in the middle of those two.
All right.
I will tell you, if the market sells off, though, Johnny, I'm sorry. If it runs, if AUPH gaps up and runs tomorrow, even if it's like 50 cents,
Sell the 9.
I would start buying the protection first.
Yeah, okay, that makes sense.
And that's something I've been doing all of my option trades to do these spreads. In the beginning of the week, I look for the cheapest options, the cheapest puts I can find, knowing that I'm going to make a bet on Amazon decaying. So I'll buy some cheap puts for a penny to 4 pennies max. And I'll just keep that protection all week. I'm not looking to make anything on it. I'm just keeping that protection in place in case I open it up for a spread. So for $40
for a minute.
So $40 for 10 contracts as protection, then you can open up the short side. So I like to leg in the protection early.
All right. All right. Well, thanks, guys. I mean, that was a big education for me. We could keep on just to get off of the AUPH. I'm looking back at the market right now. It seems like we off the lows, 3,089, bouncing off the lows. Dropped for some reason. Right around time was that? I have everything in military time, 9:30 maybe.
Some takeaways though.
Yeah.
Number one, if you're doing a spread, the goal is not to hold it to expiration. You're trying to make the meat of that decay. You're trying to capture that as much decay as you can, as quickly as you can. And once you take the bulk of that, move on, find another trade.
Guys, I got to turn into a pumpkin.
All right, man. Keldar, great job today. Thank you so much.
Yeah, and let us know tomorrow. I'd be interested in hearing when I get in.
Yeah.
What you actually end up doing, because I like that idea. If it gaps one way or the other, especially if it gaps up to buy the protection and get that leg out. And honestly, if it gaps enough, you might be able to sell the 9s if you can get that same $1.25.
Yeah. Hell, if it gaps enough, I won't have to worry about anything.
Well, no, but in the grand scheme of things, it's not a bad idea to do it either way.
Yeah. No. This is great information.
You have the two most important things working for you right now. The fact that the implied volatility is so jacked up.
Yeah.
You want to sell high implied volatility. When that news comes out, John, it may just be a non-event.
It might be, right? And boy, that's going to really...
those 8s are just going to depreciate so quickly.
Yeah.
Mm-hmm.
And you're going to collect that money, and you might still be sitting at $5 with your position, and you just collected that
Thanks,
money.
guys.
Take care, Keldar. I'll let you get going. Thank you, man.
Bye.
See you in the morning. Yeah. All right. So, yeah, I'm looking forward to testing that strategy out. It'll probably be the first time I've done that.
Well, listen, the way I look at it is, would you buy a house without protection? Without insurance?
Well, I guess not, no.
Would you buy a car without insurance?
You can't. But I've
So
tried that. I tried that before.
Why would you buy a sizable stock position without buying protection?
Yeah, that's a good question. We also have earnings out tomorrow, but this volatility is a little bit more than earnings volatility, is it? I mean,
I think so.
Yeah.
If there's news on the horizon, that's what's
Yeah.
juicing this up.
Oh, definitely. I mean, there is news tomorrow. There was actually some after-hours news on this stock today that a board member has left right before earnings too, and right before this. It's it's getting kind of hectic.
But again, I'm going to reiterate: implied volatility historically will go back down.
Yes. Yeah. Yeah.
So you want to sell it when it's jacked up.
Even if it came out with good news.
Yes, because you see, perfect example. I'm glad you said it. How many times have you guys bought an option position ahead of earnings?
Mm-hmm.
When the earnings come out, even when that thing is in the money, a lot of that premium comes out of it. And sometimes you're like, fuck, I had it right. I had the move up that I was expecting.
Yeah, it didn't move.
Were great, but the option volatility just evaporated.
Kind of happened with my coupe. I expected a bigger move, and it didn't move as much as I did because it was so tight, the range. It was expiring too fast.
Johnny, it happens 90% of the times. Holding stocks over earnings is a losing proposition. I'm sorry, holding options over earnings is a losing proposition.
It sure is.
I would rather sell them.
We have AJ saying here on AUPH, why not buy a put debit spread? Buy the 4s and sell the 3s.
Buy the 4s and sell the 3s. We already long the stock, though. I don't know why you'd want to. Why would you want to put a debit on it?
I don't know. This is just a question in the basement here. On the why not buy the debit? Why not buy? Why? Why not put on a put debit spread? Buy the 4s and sell the 3s. But I only play what the earnings. I play what the earnings are pricing in. If the ITM or ATM are priced high, I play the standard deviation for the move that's priced in. Okay.
Depends how you want to do it.
Yeah.
I would rather sell that implied volatility that's all jacked up, because I'm thinking if you collect $1 on those 8s, is that what it was? $1 and change?
What was that?
$1.20 maybe.
The 8s. These January 8s.
Yeah.
Well, yeah, 120. Let's say 120.
Hold on a second.
They're 110 to 145.
I'm gonna look at the percentages on those. Sorry, I had to get another drink in the kitchen.
Yeah. Do I have a drink?
AUPH. Eights going out to January are $1.10. So right now they have
There's no
those
volume
eights
on it.
have an 82% chance of expiring out of the money. John, that's a good bet.
Yeah.
I don't care that the yeah, Yamada's saying as soon as you put that offer out there, somebody's gonna nickel you. I don't care that there's the implied volatility on that strike price is 222%. The fact that it has an 82% chance of expiring out of the money, you see, Keldar and I don't take trades for usually less than 80%.
Yeah.
This meets the criteria. If this thing runs to $6 or $7, John,
Yeah.
those 8s might not be worth that much still.
Going out to January, yeah.
They may be worth $1.10 when the stock is $7 at that point.
How do they know what causes the implied volatility to spike like that?
Uncertainty.
But who determines that uncertainty?
I think it's factored into the prices and the historical volatility, but
Like if there's no volume on that, there's no volume on the 8s today at all, but there was 6. But yeah, like who know? Is there do they know that an event is coming up that they price it in, and how would they know that, and how does the computers recognize that and adjust for that?
yeah,
Just
I'm not
curious.
that
Yeah,
smart.
right. I don't know.
I'm not that smart to be able to tell you why. I just know that implied volatility should move back to the mean over time. So that 82% chance of it expiring worthless,
Yeah.
I think, is going to be much greater very soon.
And
Unless we're totally wrong and this thing is going to $10, but
And one more thing, when you see that percentage, you're using Thinkorswim for that tool.
correct.
All right. And if you don't have Thinkorswim, is there any way to figure that out? The percentage of that trade working out, or is it just you might as well put $10 in just Thinkorswim and just grab that?
Yeah, exactly. It's a really great platform for analytics.
Yeah.
I'm not that smart, so I use this.
I gotcha. Yeah, I need that too. I need someone to walk me through a couple times before I even start to understand what's going on.
But again, you're just betting, like for our spreads, we're just betting where it's not going to go. I don't care where it goes. I'm just betting where it won't go. So I'm making a bet that this thing isn't going to go above $8 by January.
Yeah.
If it does, John, big deal. They take it away from you, and you're selling it at $9 and however much you collect on.
Yeah, $1 more, right?
So maybe you sell it at $9, $10. If the stock goes to $10, big deal. You're selling it at $9, $9, $10.
And you're making that money anyway.
Yeah, and if it goes down, you're keeping that money. The only problem with selling covered calls is you're not really protected to the downside.
But
You're capping your upside and you're not really protected. Now, if you had puts, if you were long puts, yeah, then you're protected. I mean, I've sold calls against stocks that just kept going down. Happened to me in Beyond.
Yeah.
I bought at 145. It went to 160. I didn't sell calls against it. It dropped to 120. I sold calls. It dropped to 110. I covered the 120s and sold 115s. I sold it all the way down. By the time I got to 120, I'm like, I can't take this anymore because I'm losing more money on the options. On the stock than I am on the calls that I'm selling. So I puked it out. Look at where Beyond is now.
Yeah.
My last sale was at 120. Beyond is currently trading at $80.
Yep.
So it's great if you're selling calls and you're collecting premium, but you really have no protection to the downside. That's why covered calls don't always work for you. But you're in a unique situation. You have screaming implied volatility.
What is extreme volatility? 200%? I mean, what is the highest levels have you seen that indicator at?
400%.
400%.
I mean, normally, here, let's look at.
What do you say it's back to the mean? What would it be a mean on that? What is it normal? What's a normal volatility? Implied volatility.
Normal volatility, 15.
Yeah. Well, that's big.
10. You know. They tell you, I think it's Tasty Trade. They tell you to look at the current IV percentile. And in this stock, it's 95%. That's huge. That's big. Usually when like an Amazon or like an Apple ahead of the earnings, I believe it's usually over 100. So this is pretty high, John. You're in a unique position, though, because you got news coming out on a stock. It's probably going to be good. You have the best of both worlds.
Yeah.
Good news coming out, probably. The implied volatility is sky high. You want to look to sell that. Even if you sell it and the stock rips, you're collecting over $4,000 more.
Yeah.
You know what I mean?
Yeah.
Yeah, you're limiting your upside, but technically.
Well, you know, what if we're expecting upside on this to $16?
Oof. All right. That's one of those ones you say shoulda, coulda, woulda then.
Yeah.
You really think this thing's going to 16?
Yeah, I think that's a fair valuation on this drug.
Okay. Well, lupus is a big deal. They don't have a cure, right?
Yeah, no.
There aren't really many competing drugs.
This would be the monopoly drug. This would be the first drug FDA approved for this type of lupus, the advanced stages of lupus. There is two lupus drugs, but this is nothing this is when lupus attacks your kidneys. So this would be the first one. They'll be the first one.
They're going to get orphan status, which means they're going to have a monopoly on it for a short amount of time.
Yeah, that's going to be a
years.
monopoly, and they're expecting that. I think I have my information here. Who's supposed to be looking at them? You know, possibly looking at them. I think it was who is it? I don't know why I can't remember it offhand. Was it Merck or it might have been Merck? They have a drug that competes with not competes with lupus, but the same drug that works for lupus also works for. They're using it for dry eye syndrome, and they're in phase 2, and it's already beating Restasis drug in head-to-head comparison trials. That's the only other drug for dry eye syndrome. So they have another drug that's getting benefits from that, and they're expecting that to be bought out. So they might have to sell that. So there's a lot of good things on this, and they actually, they did hire 2 vice presidents to commercialization in the United States over the last month. The insiders came in and started buying this last month. I mean, there's just so many positives. And they did an update, like 48-week update, and everything was on schedule. So, there's a lot of positives there. But yet the price didn't move. It doesn't react to what seems to be a positive setup, which I have, never understood sometimes in the market how that sometimes happens.
Yeah, no, Zouch is saying that's a lot of gains you're going to give away if you sell it at 8. Yeah, that's the trade-off.
Yeah.
You're afraid this thing may go to 4 or doesn't go above 8. I still think it's a good bet. If it goes to 16, God bless.
Yeah, well, I could take a little of it just to test it out. I would like to see how the whole trade works.
Yeah, or sell part. Yeah,
Yeah.
John, sell part of it.
Yeah.
Sell even $1,000 versus it. Sell
Yeah.
10 cars
Yeah,
at $1 and change.
that's what I'll do.
So you still have 3,000 if it rips. You know, you'll end up making 11 points on 3,000 shares. Yeah. Zouch is just doing the math for you. I don't know. I think
All
you're
right.
in a great position, though.
All right. Well, I'm looking forward to seeing how this whole thing plays out in the next few weeks. We should call it, though. This was a fantastic show.
I feel like we didn't cover anything.
Oh, man. We just went over so many examples. It was great. I think I used you guys more for myself than anything else. Does anybody out there have any questions for Rob? I mean, I'm not going anywhere. I always want to, sell at the highs. Like we got Rob here on the phone, and we had Switcher call in earlier. But if anybody has any questions on options or positions they have or anything like that, I'll even look down in the basement here for a second. The options that are out, 2 standard deviation OTM, they're cheap because they don't price these moves in. So, John, you own 22,000 shares worth of stock in this? No, KH. Oh, yeah. Well, not 22 shares. I own 4,000 shares, which is about that. And I own some options, too. AK-47. Is that your brand that you're enjoying tonight?
Yeah.
Nice. Oh, I see someone in Village are asking what's the flavor. I had who told me about AK-47?
Drinking lemonade. That's my evening.
Someone told me about AK-47. I said, AK-47? That sounds great. And you're having a lemonade?
Having lemonade, man.
That's great.
I was gonna have some scotch for the show. I didn't hear anybody else was drinking with us, so.
I've been pretty good at not drinking anything. I just don't like the after effects now. I'm so happy.
John, I have to tell you, I'm not a big drinker.
Yeah.
I've never been a big drinker. Some of the women I've been out with are huge drinkers.
Huge.
It's just not. I can't do it.
Yeah, it's not healthy. I realize it kills your liver, I think.
I got a lot of shit going on. You may not think it because I work from home and I trade from home, but I got a full plate and there's a lot of moving parts.
Yeah.
I can't be hungover and have to waste a whole day because I can't do anything because I feel like shit.
Yeah.
Trying to be healthy and you really want to be in the right frame of mind when you're trading.
Oh, that is 100%. 100%. I mean, tell you, that's the biggest thing for me is if I'm out of a bad mood or anything, I'll sometimes just sit here and look at the computer and just be pissed off.
Yeah. You break up with your girlfriend or boyfriend,
Yeah.
your dog dies, whatever it is, you got problems, don't trade.
Yeah.
Because you're going to make decisions that you wouldn't normally make, and you're going to force things. And the problem is, I don't know if you believe this or not, but it's those of you who've traded for a living, I know you'll embrace this, but if you don't think it's possible, every trader has a financial death wish. So when the market, I'm serious, there's been books written about it. When the market is moving against you and you take bigger losses than you normally would, and you know it's the wrong thing to do, you still continue to do it because you have to feel that pain. Because that pain, you feel alive. And it's a sensory thing. I'm not making this shit up. There's books written about it. They call it controlling your inner knucklehead.
But don't you want to feel the good pain, like the
elation?
the elation of a good positive. You're searching for that positive feeling. You're feeling for that high, right?
Right. But when the market is selling off and you're fighting a position and you're just watching this thing go down, how many times did you say to yourself, shit, if I would have just turned around and shorted this thing when I was long?
Sure.
It happens all the time.
Yeah.
But we all have ingrained in us, we have whether you believe it or not, there's a financial death wish. And you need to take that pain to actually feel alive. Yes, you're getting beat up.
I feel alive. I don't want to take that pain. I feel alive, man. I don't want.
I'm saying, but when you're fighting losing positions, that's what happens.
Yeah.
You take bigger losses than you normally would. You get stubborn. So that's why I use a tight stop, and I don't dwell on things. I made a comment to
Deep
Ryan, I think it was Ryan or Yamada. I can't remember. Oh, it was Ryan G. Vale. He was fighting a position.
Yeah.
And I said, why would you fight a position? Why would you spend all of your energy on watching this position that's going down?
Yeah.
Just get the hell out and reevaluate. Pick a better entry point.
Yeah. Yeah, because you're going to have the same amount of money.
Over the years. I've made every mistake possible that a trader could make over the years. I've made a lot of money. I've lost even more. Well, not now, but I've lost a lot of money over the years. And I'm telling you, it's not worth fighting positions. It's not worth Paul being in a fucking futures trade and being down 20 points. Who in their right mind takes a 20-point stop loss? I know he didn't set out to do that.
I don't know what to say, really.
But why wouldn't you just get out and reevaluate? Stop out, take the loss, figure out what you did wrong, and find a better entry. There's nothing more debilitating than watching a losing position, because it makes you question yourself.
As a team.
And then you might be trigger shy the next time.
Inch by inch.
Losses are a part of doing business.
Till we're finished.
You're not always going to be right.
We're in hell right now.
But why let a $200 loss turn into $2,000?
And we can stay here.
I don't know. It doesn't make sense to me. I've tried it both ways, and I'll tell you what. Taking tight stop losses works.
Into the light. We can climb out
and I sleep at night. Not very well, but it's not because of the market. It's just I just don't sleep well, but I sleep a lot better knowing that at the end of the day I'm going home. Win, lose, or draw. I'm not fighting anything.
You started selling.
If I was wrong during the day, I mean, I'm not talking like a stock, mostly futures.
Yeah.
But if you're wrong, just get the hell out.
Get out. I always say there's I kind of try to put it into an easy way of understanding. I say, John, I'm out. I have to wait for the stock to come back. I said, well, you had 10,000 in this position. Now you have 8,000, but you need to, I said, even if you sell it, you still have 8,000. You could put that 8,000 to work in something that's going in the right direction instead of waiting for something, that's not going in the right direction. So you could make that change at any point. You need to get the hell out of something that's not working, because it doesn't make sense to be in something that's not working, where that money is going to be the same right now. Right now, you take it off. That money is yours. Now you can put it into something else that's heading in the right direction.
Right.
It's heading in the right direction instead of waiting for it.
Thousands of stocks to choose from. Why are you going to sit in one that's losing money when 11 others are going up in the same minute?
Yeah, and that money is going to be the same if you hold it in there or if you take it out. Nothing's changing.
Right.
It's like Al Pacino said. You said before. You've traded every single way. This is the great line here.
Yeah.
Here.
I look around. I see these
I can't do it.
Faces, and I think
I don't have the stomach. to sit and watch losing
I made
positions.
Every wrong choice a middle-aged man can make.
The way people say, Rob, where do you put your stop in? You know where you put it in? where you're wrong on a chart.
Yeah.
If it gets to that level, no questions asked. You get the hell out.
Yeah.
If it's a divergence,
Yeah.
if it's a Fibonacci, where you're wrong, you get out.
Yeah.
And then you find a better spot to enter.
Yeah.
It doesn't make sense, because I'm telling you what, the more you fight positions, you start to question yourself. Then hopium comes into play.
Yes. Yes.
You know? How many times did you chase a stock because of the euphoria? There's good news, or Mr. Land comes out and says something, and you chase a stock. And all of a sudden it turns on you. And you're like, oh, it's got to bounce here.
1 minute by
Goes lower.
divergence.
It's got to bounce here.
Order
Goes lower.
filled. Order submitted.
You say, well, I
Order
could have just turned
submitted.
around and shorted
Order
this thing, or I could have
submitted.
just got out and picked a better spot. Why fight a position? Just, it doesn't make sense to me anymore.
Yeah. Hopium is running rapid in these markets.
Yeah, hopium should not be, hope should not be a strategy. If hope is all you have on your side as far as a premise, you might as well send me the check. Cut me a check, send it to Rob, Belmar, New Jersey, and I'll spend that money the way you never would have.
Yeah. And I'll take you out to dinner with it too. At least you
And
get
I'll
some,
take you out to dinner once I get that check.
at least you get something from it.
Yeah. I'll be nice enough to take you out to dinner. You just gotta pay.
So what is the three things that there's no there's death?
3 guarantees in life.
Go ahead.
Death. Taxes. Option premium decay. You saw the chart on your screen. If that doesn't give you incentive enough or get you so fired up that selling premium option decay favors the seller. Again, if the market goes up 53% of the time on average, if you could take a trade, even though you might not make as much money as you could because you're incurring less risk, why would you not take a trade that you could make 80 to 100% probability of success? Again, if you buy long options, you have less of a chance of making money as if you sold puts.
Yep.
Out of the money.
This is gold, people. This is gold. I mean,
Gold, Jerry. Gold.
do you know that 1970, this day in history, Felix Unger got kicked out of his house. November 13th, Felix Unger was asked to leave by his wife.
That's right. Love that show.
2019, President Trump is being asked to leave his house. Coincidence or conspiracy theory?
All right, here. I'm going to give you an example. Somebody PM'd me before
1
and said
minute by
they didn't
divergence.
understand this when I said it. I remember it from the last class we did. Hold on a second. All right, let's do a live example. Just to show you the math involved here. Pick any stock. Switcher likes Roku.
Yeah, let's do
Right.
Roku.
Let's look at Roku for the man. The man with the plan. Okay. So right now, Roku's trading at $142. Let's say Switcher and yourself are bullish on Roku.
Yeah.
Okay, so 142. So I know you like to buy out of the money calls, John.
Yeah. Well, yeah.
Usually,
Yeah.
right?
Yeah. Usually a week or two out of the money. Sometimes a month.
Okay, so it's trading at 142. Let's say you think you're bullish and you think this thing is going higher,
All right.
right?
Yep.
And you buy the 145 calls,
Yep.
which are $2.50 call it away.
I think I just did that
Right.
recently too. I can actually show you my example.
Okay.
Well, I'm just saying I did. I bought the. What I bought? Well, anyway, go ahead. I did buy the 140 calls last week.
Okay.
I
So
don't want to interrupt.
right now, if you bought the 145 calls, $2.50 out of the money, expiring next week. So next Friday, so 9 days from now, you have a 39% chance of making money on that 145 call.
They trade.
Now-
They trade in weeklies. Why are my calls not coming in on this as weeklies? Let me see. 2 days, 65 days.
You know what? Let's do this week in a couple of days, because this will hammer home the point
All
even
right.
more.
Yeah, it's easier for me because I have that up on the screen.
Okay. So right now, those 142s have a 42% chance. No, sorry, 48% chance of making money. 42% chance.
Okay.
$2.50 out of the money. No, I'm sorry. Scratch that. 145. Sorry, there's a 32% chance that you're going to make money on those 145 calls, $2.50 away.
Yep.
But if I want to sell the 139s, which is $2.50 away. No, call it the 140s even. You have a greater chance of making money by selling those puts. You have a 57% chance
All right.
of those puts you sold expiring out of the money versus the 31% if you buy the long calls. So again, option decay favors the seller. You could be right in your premise.
Yeah.
But if it doesn't go up to 145 in 2 days, you already have the odds stacked against you. So why not sell the puts?
Yeah.
Again, two things working for you. The two most important things. You want to take advantage of time decay. This is why you sell premium. You want to take advantage of time decay, and you're willing to make a limited profit
Yeah.
to improve your probability. So you're willing to go further out of the money because the chances of you making money are greater. So yes, because there's a greater chance you're going to make it, there's less of a premium you're collecting. But again, they add up. This Amazon example, I'm 130 points away. I'll probably choke on it tomorrow, but I'm fine with taking a $300 gain a week in just Amazon. And sometimes you see I do this 3-4 times on a Friday. So that $300 sometimes turns into $1,000. So if you do that 4 times a month, times 12 months,
Yeah.
weekly options are where it's at. And it's because of what? Time decay.
Yeah, time decay.
Time decay is the greatest thing ever. It's better than sliced bread. It's better than old Run DMC.
No, it is. Yeah, Rob, I want to just shut down the video so I make sure I save it. I'm not saying
Order
goodnight. I just want
filled.
to tell everyone
Order
that there was
canceled.
tight stops
Order
in Keldar,
canceled.
and we're gonna stop the recording now. And I'm gonna put that. I'm gonna post that tomorrow in the
Order submitted. Order filled. Order submitted.
in the
Order
forum.
submitted.
So let me
Order
stop this
submitted.
here so I can start because I need to.